In this video, I'm going to go through the exact system that I've created over the course of 6 years in my trading career to make sure that I can consistently pass prop firms and get payouts on a bi-weekly basis as a bare minimum. Now, I've been trading prop firms for the past 4 to 5 years, and I can tell you now I've broken down at every stage. I've failed on the first phase of challenges. I've failed on the second phase. I've got funded and then failed before I could actually get a payout because I've breached the account. And then I've had payouts and then blown the accounts after that. So I finally got to a stage over the course of 6 years where I've now managed to get consistent payouts on a bi-weekly basis. And I want to show you guys the exact system in this video. I know how it feels to go through all of them stages. So after taking all of the time myself, I've compiled it into one video that I'm going to show you guys here, so you guys have no reason as to why you can't do the exact same yourself. Let's get right into the video. Okay, so diving straight in, like I said, this video is exactly how we're going to pass a prop firm with maths, and I'm going to break down every stage with the specific outlook and approach that you need to take here. So the first thing we want to identify here is the problem. The problem that you'll be facing, as I did in my whole 6 years trading, is you will be failing prop firm challenges. You'll be passing some and then losing the account before the payout, or you'll be stuck in a cycle of reset and retry. And this can happen over and over and over again. And I know how frustrating this can get, which is exactly why I've built this. But this is the problem that we need the solution to. So the core idea here from all of this is that prop firms are an insane risk to reward opportunity. As I'm sure you know if you've been trading them already, you are able to leverage so much capital with prop firms that it would be stupid of you not to take advantage of this if you are a trader. And most traders mess it up because they're either too conservative, so they're stuck in a challenge phase forever, or they're too aggressive, so they're blowing accounts ridiculously fast. And I see this so often as well. Don't worry, you're not the only person doing this, and it's hard to find that balance. The edge is the middle ground. The edge is where you can find a way to balance it so you're not actually stuck between taking too long on these challenges, but also trying to rush past them and blowing accounts and spending money that you can't afford to spend. So there's a key mindset shift here that I want to make sure you take. And that is that you don't actually make money in the challenge phases. For them people that play super conservative, you're not making money when you do that. You might be increasing the percentage profit on that account, but it's not your money. You only actually make the money when you're funded. So thinking about that and keeping that in mind, the real game here is pass fast, stay funded, and extract payouts consistently. That is the method that we need to follow. That is the program and the system that we need to keep in place throughout the entire time of you trading prop firms. So now we can go into why prop firms are actually powerful. I want to dig a bit deeper into this just so you can understand the true power of prop firms and what we have here as traders that is ridiculously overpowered. The example I want to use is your standard 100k account using forex pairs or using CFDs is around $500. You can go to many prop firms. We use places like FundedX, Equity Edge, and they're all around $500 for an 100k account. And if you get 1% gain on that funded stage with that account, then that's $1,000. So thinking about that, using simple maths, you can literally double your initial cost with just 1%. That's all you need to make is 1% profit on a challenge on a funded, and you've doubled the amount that account costs for you to get. So even if you fail multiple times, let's say you buy 300k accounts and you fail and you spend $1,500, but then you pass on the third one, you only need 2% on that third funded once you've actually passed it to break even and end up in a profit. Everything after that is profit for you. And that's how powerful they are. So that's something that I really want you to consider for a second. Once you actually break through this and get your first consistent few payouts, you've paid for everything and more that you've ever spent on this game. And that is the power of trading and trading with prop firms. The common mistakes that everybody makes, though, is they're too conservative, so they have tiny, tiny risk amounts. They have really slow progress, and they're constantly stuck in the challenge phase, which I'm sure a lot of you will be, or they're missing earning opportunities because of this. Or like everything has a yin and yang or a complete flip side in life. Some people can be too aggressive. They'll be buying loads of accounts at once, completely over risking on every trade and lowering the probability of a payout. And I think a lot of people speak a lot more loosely in today's day and age when it comes to the trading space and tell people to be as aggressive as possible with the challenge phases. Now, although a sense of aggression is definitely worth doing, being too aggressive is just as much of a hindrance as it is to be too conservative. So I want you to keep that in mind and don't just start diving headfirst into these challenge phases because you will burn yourself out or you'll run out of capital to do so. So how do we find that middle ground? How do we approach this? The foundation of it all is risk exposure. And there's a specific formula that I want to use for it. So the risk exposure here should be your trades per week times by your risk per trade. And let's look at examples of this. If you're somebody that takes loads of trades and you're a small scalper that's consistently on the charts, you take 50 trades a week, times that by 1% risk per trade, you've now risked 50% on that account in that week. Or if you're somebody that takes 2 trades a week and you risk 1%, you've only exposed yourself to 2% risk that week. So it's the same risk per trade, but it's not the actual same risk on the account. And that is a big thing that a lot of people don't understand and don't really get. You're risking so much more, or you're exposing yourself to more risk the more trades you take if you keep the same risk percentage. And that's where being aggressive can mess you up if you don't calculate your risk exposure properly. So there is a master formula for this. And that formula is the risk per trade equals your maximum drawdown divided by your risk to reward ratio divided by your trades per week. So let's take an example account like FundedX. For example, I know that your maximum drawdown on them phase 2 challenge accounts are 10%, and on a standard trade that we would take, your risk to reward would be a 2 RR, and the trades per week that we would take on a standard basis are 2 trades per week. So if you've got 10% and you divide that by 2 for your risk to reward, that is 5, and then divide that by 2 for your trades per week, that leaves you with 2.5%. And that is how much you should be risking if these are your parameters on trades in the challenge phase, because you're risking 2.5%, which gives you that comfortable amount to comfortably risk that per trade and get through the challenge phase at a good pace. In the same breath, if you're somebody who takes 20 trades per week, let's keep everything the same. You've still got your 10% max drawdown, you've still got your 2 RR, but you take 20 trades a week now, you should be risking on them trades 0.25%. Now, that might sound really small for some of you, but for them people that do take 20 trades per week consistently, you'll notice that you're actually blowing these accounts really, really quick, like consistently. So this is where you need to consider your risk exposure here. And this is the backbone of everything. Finding that middle ground, that balance, is what makes the most sense when you pass the accounts. So again, keeping this in mind, let's look at part 1, the challenge phase in particular. The goal here is to pass fast, not perfectly. You don't want to pass with pristine conditions. You want to pass fast and get there quickly. So the time rules on the maximum on a CFD account, or when you're trading forex, should be around maximum of 2 months. Any longer than that is a wasted opportunity. You should not be spending more than 2 months on one challenge account. Not at all. And the question that you want to ask yourself here when you are considering this is, do you care about the challenge fee? Let's say you spent $500 on your 100k account. Do you care about that amount of capital coming out of your bank account? Is it detrimental to you, or is it something that you can comfortably just put aside and throw away for this? If you really care about this, then let's look at the safer approach. Your risk should equal your max drawdown divided by 2 divided by your trades per week. So again, a moderate risk with a controlled pace. If we take this back to the example we used before, drawdown is 10%, divide that by 2 is 5%, trades per week is 2. So you can risk 2.5% to be conservative and to be safe on the challenge phase of your account here, and you'll have no problem. Now, if you don't care and you're looking for a more aggressive approach, then again, in the CFD space, when you're looking at Forex accounts, your risk can equal your drawdown, which would be 10, let's say for an example, divided by 1, which is still 10, and then divided by your trades per week. Let's say I take 2, sometimes 3 trades per week. You're looking at around 3 to 5% risk per trade if you've got an aggressive approach here. Now, again, these are numbers that I am using, that I'm just randomly plugging in. You need to plug your own numbers into these formulas to make sure that it works for yourself. But you can see the difference here. With this, we'd have a faster pass rate, but we would have a higher risk on each trade. On each account, you would be more likely to lose the account if that account blows. Now, again, be cautious of max daily drawdown, because I want to use the example here that I have off the top of my head with FundedX. The maximum drawdown on the account is 10%. So that would mean 10% here divided by 1 is still 10. And then let's say I take 2 trades per week, that is 5%. Now, the maximum daily drawdown on a FundedX account is 5%. So if I do this, then I'm going to blow the account in one trade. If you really don't care and you want to be aggressive, you can do that. I would never recommend it. In this case, I would probably come 1 or 2% under. So bring it around that 4% mark. Because like I said, if you take 2 to 3 trades per week here, that's going to be 3 to 5%. So maybe drop that down to 4% so you don't blow the account in one trade, because I would never recommend losing or risking absolutely everything in terms of daily drawdown on that account. That's something to really be cautious of, and have a look at your own prop firms that you trade with to make sure that you're in the green or you're safe there. Now, moving on to why this actually works. This is entirely because you're controlling how fast you pass and how likely you are to blow your account based on your weekly exposure. So, this is entirely specific to yourself based off how you trade the specific strategy that you decide to trade every single week. You might copy somebody's strategy. Let's take ours, for example. You might have seen a few of our videos and you might like the strategy we use, so you trade that strategy as well. However, you might trade it completely different to us. And this is the thing that most people miss when they're copying strategies or copying things online. Let's say you take our strategy and you trade with it on different pairs 10 to 20 times per week, but we only take 2 to 3 trades per week on it. You're risking a lot more. Your exposure to risk is so much more, even though we're both risking 1% per trade, which is what we tend to do with ours. And that's because we've worked this out. However, you're not taking that into account with it, with whoever strategy you're copying or whichever strategy you're using, because you've not used the same risk exposure as that person. And this is why you need to use these formulas so you can calculate your weekly exposure to make sure that you're trading that strategy to the best of its ability when it comes to risk. Now, part two is to get onto the funded phase. Let's say you've been through and you've been cautious of the max daily drawdown and you've used these formulas and you've managed to pass an account. Now you're on the funded phase. The goal here completely changes. The goal is to protect your account and extract payouts. That is the most important thing above everything else. So the new risk reality here is losing a funded account equals losing an income stream. Treat this like they are mini multiple jobs. Every funded account you have is an income stream, and if you lose that, you lose that income stream. So if you go back to the challenge, you're back to $0 and the opportunity becomes real. This is where it becomes genuine, a chance for you to be able to earn capital consistently from here. And if you're struggling, I want to add quickly, in any part of this process, or you feel like you need a little bit of extra guidance, then make sure to book a call with us in the top link in the description, where we'll go through with you for free about your specific processes and how we might be able to help if there is still spaces open for our mentorship. If you don't want to, that's entirely fine. Let's crack on with the video. So, moving on to balance, you want to make sure that you are balancing this perfectly, because you can either be playing too safe here on the funded phase, which means you'll be getting tiny payouts that are not meaningful at all, because now that it's real capital, you'll start to panic and play really small with it, which happens a lot and that's completely normal, but you'll be getting tiny payouts which are not meaningful. Or you'll play too aggressive because you're excited about the fact you can earn all of this real money now, and you'll lose accounts. You'll start blowing them. And I can hold my hands up and tell you now, I have been guilty of both. When I first past my first few funded accounts, I was so scared of losing them that I was playing too safe, and I was getting tiny, tiny payouts that would actually do nothing to change my parameters in life to make me quit my job. And then I thought, I need to change something here. And what am I doing? I've got so much opportunity. So I started to risk everything and I lost a load of funded accounts. I've been on both sides of this and I completely understand how you feel if you've experienced any of these. And when you get this balance, that's what changes everything for you with these funded accounts. So you need to look at a specific payout strategy. And the question here is, do you want consistent payouts or do you want big payouts? That's a big question you've got to ask yourself, because that completely changes how you trade in the funded phase. I would always recommend taking consistent smaller payouts over big payouts any day of the week. And let's just look from a CFD example in Forex specifically. This is the thing that you could use. So your risk could be your drawdown, which again, let's say is 10% here in the example, divided by 4, which would be 2.5, divided by your trades per week, which in my case would be 2 to 3, is around 1.25%. And with this, you've got lower risk, which means you can get more payouts and you can get stability. Now, one big thing I want to add, don't miss this here, is beware that some, if not most firms, only allow max 1% risk per trade in the funded phase. I know Funded X do this, and I'm pretty sure that Equity Edge do this as well. So check with your specific prop firm to make sure that you can risk more than 1% if you're going to. But if not, ignore this and just risk 1%. Consistently only risk 1% on them trades to play it a lot safer and to make sure that you don't breach the account for whatever reason. That is important. If, however, you can risk more and you want to risk more, then go and you're looking at bigger payouts. Then again, in the CFD example, let's say your risk is 10% and you divide this by 2, which is 5, and then divide that by your trades per week, which is 2. So that would leave you around 2.5%. Again, in this case, you guys might take more trades. Let's say I take 4 trades in a week here, then 10, or I take 5 trades. 10 divided by 4 is now 2.5, and divide that by 5 for my 5 trades a week is now 0.5% risk per trade, which is probably a more likely number that I would take myself. Is if I'm looking if I have less accounts, then I'm going to take a smaller risk because I don't want to lose them. And as you get more accounts, you take more risk, which we'll be going on to in a second. But the real insight here is you're going to be more consistent. Payouts are going to be so much better than occasional big wins. This makes such a difference in not only your trading, but how you live your life. When you know that you have consistent payouts coming in, you're not worrying anywhere near as much. And there is a benefit to doing this, but that it has to be done right. And this is the most important bit, in my opinion, is how to scale, because you've got a funded account, you've got a payout, but right now, how do you scale past this? How do you get consistent bigger payouts? You want it, instead of increasing risk, you want to increase the accounts that you have. This is so important. Every time you get a payout, if you can, allocate as much money as possible from that payout to buying more accounts. You want to have multiple accounts, potentially look at copy trading, but then this way you have a higher total drawdown because your bigger payouts with extra risk per trade here. So what this means is, let's say you've got 100k account and you're starting to get consistent payouts on it, and now you think, right, now I want to start earning more. Instead of increasing the risk on that account, you're now increasing your chances of losing that account, losing that income stream, and losing all your methods of making consistent profits. Instead, buy more funded accounts, buy 3, 4, 500k funded accounts and pass them, and then keep the risk small, keep your risk exposure the same. I can't stress it enough. That's what this whole video is about. And then you can just do it across multiple accounts, because now you're less likely to lose these income streams because you've got multiple of them and you're not risking more, but you're going to make more profits. You're going to scale and make more capital doing this. So let's look at the money loop that is created from all of this. Phase one, you're spending money on challenges and you are negative. Looking at your bank account, you've spent money here, you are negative. Phase two is you get funded and you can get yourself back to break even on the capital you spent on the accounts because you've now got funded. Phase three is you start to get consistent payouts, so you go into the positive. You're now making profits from this trading and you've got positive amount of capital in your bank account. And then you buy more funded accounts and you cover your cost entirely, and you are now risk-free trading with no problem at all. And if you follow this perfect money loop, this perfect cycle, then you cannot mess up. So this is the specific loop that you need to follow with these specific systems and these specific formulas, and you cannot mess up. It is literally proven by maths. So the final principles that I do want to go over with you, just to sum up the entire video really, are pass challenges quickly, don't get caught up on them, don't sit in evaluation forever, maximum of 2 months, absolute maximum really. Reduce the time spent losing because you're going to lower your risk exposure and you're not going to get caught up on losses. That's completely different in a psychology video, but reduce your time spent losing and protect your funded accounts. When they are live and they're funded, massively lower your risk exposure based off the formulas we've used here. Also keep in mind maximum 1% if you are looking at going over that. Just be aware with your prop firm, and then focus on consistency over hype. Being consistent wins every single day of the week. Now, that is everything for this video. I hope you guys did enjoy. If you want to see more like this, make sure to leave a comment and let us know what you actually want to see from us. And that is everything. I'll catch you in a bit. Peace.